You can reduce risk exposure. You can spend more to enjoy the things that are important to you now. You might be able to retire sooner if you're not already retired, and that's an important goal. You might be able to travel more or engage with the arts and entertainment. You might be able to leave a larger estate for children, grandchildren, for charity. That is our mandate. That is your mandate to yourself. You are your existing client. You are your existing shareholder. You are the innovator. Moneyball is the innovation. Hello, everyone, and welcome back to the Moneyball Method podcast. This is Mark Shupe, author of the Moneyball Method, a Middle-Class Manifesto for objective investing. And last week, we discussed how the capital markets had performed during the calendar year 2025. And I'd like to continue that conversation with a little bit more detail. And in particular, I concluded by saying that time-weighted returns are being replaced by dollar-weighted returns when we use the Moneyball method. And what I want to do today is again contrast the difference between time-weighted returns, money-weighted returns, and how that impacts your life as an individual investor. I'm also going to begin with a quote from the Forbes book review that was published back in July of my book. And I think this is a good way to begin. Quoting John Tamny, it's because as contrarian baseball mind Bill James explained it about baseball, a great portion of sports traditional knowledge is hokum. Shupe feels the same way about money management. He sees an investment metaphor in Moneyball that can be applied to money. That the natural world is orderly and knowable, and you can choose to live in harmony with reality or not. Again, another powerful quote. What is the money management hokum that John Tamny was referring to that I write about extensively in my book? To summarize very briefly, that hokum includes Federal Reserve policy, money supply economics, trade imbalances, ESG investing, adding alpha, sector rotation, and hyper-diversification. All of these are economic and financial concepts that are commonly used within the investment management world, yet they don't really add any value to your ability to become a successful investor. In my opinion, the Fed is largely irrelevant. And there's really only one money supply that matters, and that is money in circulation. It is always held at the ideal level. Trade imbalances are only one half of the equation of a double entry accounting system, and they ignore the credit account surplus when there is a trade deficit. ESG investing, this is political correctness. This is social responsibility. This is a way to evade the profit motive as the driving force behind money and investment decisions. Adding alpha, trying to beat the market. We're not in the business of trying to beat anyone. We're in the business of trying to meet or exceed our explicitly defined goals that require money. Sector rotation. This is trying to predict the future of what the economy is going to do, what different industry sectors are going to do, how different companies are going to perform. And it's really a lot of anxiety for and activity for the sake of activity. Hyper-diversification. Diversification is an important tool. It must be properly understood. There are many forms of diversification that are actually not very good at what they're tasked with doing. But how is the investment world orderly? There's the price mechanism. Millions and billions of market participants evaluating their own needs and circumstances and alternatives determine prices. It's extremely efficient. It happens quickly. Capital flows. Money is not stupid. Money finds talent. The profit motive. This is a virtuous and noble endeavor. The trader principle, trading value for value and voluntary exchange for mutual profit. The virtues of money, in other words, production, and wealth production in particular. Supply precedes demand. Production creates consumers. And of course, innovation. But I'm going to begin like I did last week with time-weighted returns. I talked about the returns of gold, U.S. stocks, international stocks, and the 10-year Treasury bond in 2025. I'm going to turn back the clock a little bit further. How did they do in 2024? In 2025, the Russell 3000 index, U.S. stocks grew by 17%, yet large cap U.S. companies grew 25% the year before in 2024. That's a combined return of 42% in 2 years. That is significant. That is outside of one standard deviation of the median expected return. Smaller U.S. companies returned only 11.5% in 2024, about half that of large companies. It's still a double-digit gain. Regarding international stocks, instead of 28% last year, in 2024 they returned 4.7%. Much less. That's a pretty wide swing between 2024 and 2025, but still a total return of 33% over a 2-year period. That is significant. And the significant outperformance last year can be attributed to the weak dollar. But what was remarkable at 2025 was really the performance of the 10-year Treasury, U.S. government bonds. They had a total return of 10% in a year in which the U.S. Treasury issued an additional $3 trillion of debt. Supply increased dramatically, yet demand increased even more than that. Why? I discussed that to some degree last week. But in 2024, U.S. bonds in general barely broke even. They were up 1.25%. In fact, cash had a rate of return of 5.25% in 2024. That's significant. That's a big increase over the previous 25 years. In fact, cash outperformed stocks in 2018 and 2022. So as we can see, there is rotation among the different asset classes in terms of market leadership. It's not predictable. We can't control it. But what I am going to say about 2024 and 2025 is that over this 2-year period, there was a significant improvement in the value of your accounts if you left them alone with regard to equity market performance and bond market performance. That significant outperformance relative to long-term historical averages meant that you may have become overfunded, that you may have had a problem with regard to your asset allocation or cash flow strategy that I'll address in a few minutes. But I want to shift gears a little bit right now. Instead of talking about time-weighted returns of these various market indexes, what about dollar-weighted returns? In particular, what about fund flows to exchange-traded funds, ETFs, if you will, a rapidly growing and hugely important sector of the choices that you have available to you as an investor. And to begin my commentary about fund flows to exchange-traded funds in 2025, I would like to begin with another quote from Forbes, the review of my book, quoting John Tamny, "Markets themselves inform us about markets, including how best to hedge against inevitable downturns in markets. In Shupe's words, market prices fluctuate, market leadership changes, and that is guaranteed." That is significant. But how do markets inform us about markets? Well, I've already alluded to that. Capital flows to talent. Money is not stupid. And there is the price discovery mechanism. It is efficient, meaning it is graceful, it is quick, and it is far better when left alone and not encumbered by the forces of government interference. And what is the best hedge against an inevitable downturn in equity prices? Well, the best hedge is always the asset class with a consistently negative correlation to the asset class that you're trying to hedge. What asset class has a significantly negative correlation, or at least has been a reliable hedge against stock market risk over the last many decades, would be U.S. Treasuries. But we've discussed that last week. I'm going to talk today about fund flows to the exchange-traded fund industry. In terms of individual fund flows, the single largest recipient of dollars of new wealth was VOO, the Vanguard S&P 500 ETF Index Fund. $119 billion was the net fund flows to the U.S. market through that ETF. Next was IVV, another ETF. And third was SGOV, $37 billion, an ETF that specializes in treasury securities, in particular short-term government, probably in response to the performance of the Treasury Index in 2025 and the money market funds in 2024. Also at $37 billion was VTI, the Vanguard Total Market Index Fund. Next was SPYM, a low-cost ETF that mimics the Spider S&P 500 index. $36 billion went into that, and $25 billion went into IBIT. IBIT is the Bitcoin ETF. Yes, you can own Bitcoin without actually owning Bitcoin. Same with gold. You can own GLD, which had the next largest amount of fund flows, $21 billion into GLD in 2025. The total fund flows to the exchange-traded fund industry as a whole. $1.4 trillion was invested in ETFs in 2025. This is according to Bloomberg ETF IQ, the show that was broadcast on December 22nd, 2025, so it does not include the last week of the year. But that $1.4 trillion that went into exchange-traded funds in 2025, at least through the 22nd of December, was a 25% increase over the previous year, which was a record. These are significant fund flows. This is dollars of future wealth being invested in ETFs in order to create dollars of future wealth for the investors who are buying those funds. And of that 1.4 trillion, 900 billion went into equities, both US and international. 400 billion went into fixed income. People were buying bonds, largely because yields have increased. The risk return scenario is a little more attractive than it used to be. And 125 billion went into commodities. This would be things like gold, cryptocurrencies, agricultural commodities, and energy. Another big development in 2025 was Goldman Sachs' purchase of Innovator Capital, a $2 billion acquisition by Goldman Sachs to increase their market share, to increase their reach, to increase their ability to distribute high-quality, low-cost exchange-traded funds to both institutional and retail investors around America and around the world. Innovator Capital was a pioneer for what is known as defined outcome or buffer ETFs. If you follow markets closely, you may have heard of buffer ETFs. Buffer ETFs are generally hedged mutual funds, exchange-traded funds for a particular index that you might want to follow. It could be largely U.S. equities, maybe international stocks. So what is a buffer? A buffer is a hedge. A buffer is designed to reduce downside risk. What happens when you engage in transactions that reduce downside risk? You're going to limit your upside potential. Risk and reward trade-off. It makes sense. It's natural. And for people that are not using the Moneyball method, this may be a good idea. For people that are using the Moneyball method, there is no need to own buffered or hedged mutual funds. But how do these hedges work? Essentially, the fund manager will buy the index. It could be the Russell 3000, the S&P 500, the Morgan Stanley International EFA Index, and then they will sell covered call options and buy put options as a hedge or an insurance policy, if you will, against downside risk, while limiting upside potential. It allows you a range of potential returns that is more narrow than the index itself. Again, for people not using the Moneyball method, who don't know what their funding status is, who do not have a defined cash flow strategy, this might be useful, hence their popularity. If you are using the Moneyball method, we are doing this for you. You are doing this for yourself. Your advisor is helping you hedge by calculating your funding status based on your cash flow strategy, your age and life expectancy, your values, goals, and aspirations. And we are already using the most proven hedges possible to maximize returns for any given level of risk. What I'd like to talk about now is putting principles into practice. What are the Moneyball principles that allow you as an investor to be able to hedge your downside risks without limiting your upside exposure? How is that possible? First of all, we answer the question, to make money for what? So long as we know what our explicitly defined goals are, why they are important, how much they will cost when the money is needed, then we're naturally going to avoid unnecessary risk to achieve those goals. We're going to maintain dry powder in the event of a market calamity that causes you to become underfunded. Which brings us to the practice of that principle. Calculate your funding status. What is the likelihood of meeting or exceeding all of your future cash flow objectives? What is your contingency plan to be able to, in the event that there's an extreme market event or changing life circumstances that would cause you to change strategy or change saving and investing habits? But getting back to the original question from the beginning of my discussion today, what do we do if we become overfunded? What if we have 2 years where U.S. equities have grown over 40%, where our bond fixed income allocation has grown well above the historical averages? What if we become overfunded? What problem does that pose? It's similar to the problem of when we become underfunded. You might be taking unnecessary risk. You might be sacrificing your current lifestyle. What are the things that you can do in the event that you become overfunded? What is the contingency plan? It's great to have one if you become underfunded. It's not such a bad idea to have one if you become overfunded. You can reduce risk exposure. You can spend more to enjoy the things that are important to you now. You might be able to retire sooner if you're not already retired, and that's an important goal. You might be able to travel more or engage with the arts and entertainment. You might be able to leave a larger estate for children, grandchildren, for charity. You might be able to engage in more gifting and enjoy the benefits of your gifts during your lifetime. All of these things are important. These are putting principles into practice. This is about your own personal fund flows. And I'd like to conclude my conversation with you today by quoting the global head of product management at Goldman Sachs. For full disclosure, she is my daughter, Allison Shupe. And as she said to the interviewers on Bloomberg, our responsibility is to make sure that with innovator coming into Goldman Sachs is to continue to do the right thing for our existing clients and shareholders. That is our mandate. That is your mandate to yourself. You are your existing client. You are your existing shareholder. You are the innovator. Moneyball is the innovation. And with that, I'd like to leave you until next week. Thank you for joining me and have an awesome week.